Hi, everybody. We've got quite a few people joining this morning, so I'm just going to give it a minute or two, and then we'll be underway. Hi, everybody. Okay, it looks like we've got most people having joined us now, so I'll get underway. So, good morning to you all. Thank you very much for joining us this morning for our first full CPD session post-summer. Really delighted that you can join us, and we've got a really great session lined up for you today. Before we get into that, I just thought I'd do a quick introduction. So, my name is Marie Wadeson. I'm a managing director at the K3 Capital Group. And I also lead the K3 Hub, which is a member network for professional advisors, which has been developed by a number of brands in our group. And we've been running for getting on for 5 years now. I think most of us, I had a quick look at the delegate list last night. I think most of us have met previously over the last few years. So I'm going to skip some of the usual things that I tell you, and I think they're going to appear on the screen. So what I thought I would do instead is just give you a heads up on some of the other sessions that we've got coming up between now and Christmas. So full CPD session wise, we've got employment law myths busted on the 24th of October, commercial property taxes, which is always super popular, on the 21st of November. We've got year-end tax planning coming up on the 5th of December, the day before my birthday. And then other sessions that we've got a budget bumper special, or an autumn statement bumper special, even with Jeremy Mindell on the 1st of December, where we'll have a panel session with a number of leaders from within the K3 Capital Group as well. And we've also got a really interesting session coming up on the 10th of October, which we call the Clash of the Titans. So it's hot topics and the roadmap ahead for accounting tech. So actually, also, I was on a call the other day with a colleague of mine from one of our new brands, Pareto Wealth Management, and we're going to bring you a series of economic and market outlooks delivered by Pareto's Chief Investment Officer. That will come to you in 2026, and we're really looking forward to those. So just before we get on to today's session, a little bit of housekeeping, if I may. So we are recording today's session, which you probably will have seen as you joined the webinar. Along with all of our other previous recordings, that'll be posted on the K3 Hub website in the next day or so. Q&A function is open, so please do feel free to ask questions as you go along. If you could just keep your questions to Q&A rather than use the chat for your questions, it just helps Ralph keep everything together so he knows where he's looking when he sort of starts to look at the questions to address them. We'll post a PDF of the slides into the chat shortly, and I think then the team running the webinar in the background will do that periodically throughout today's session for anybody who joins a little later. We're aware that today's session is 3 hours long, and therefore we are going to have some comfort breaks of about 10 minutes each. I think we'll be looking there or thereabouts on the hour. Poll-wise, we have got some poll questions. I think there's about 6 of them throughout the session. They're just for fun. I would encourage you to take part, though, and that will help Ralph in sort of directing, sort of placing focus on certain topics. So moving on to our speaker then. So Ralph Tiffin joins us again. Very pleased to welcome him back to the K3 Hub. Ralph is a principal of his own chartered accountancy and registered auditors firm, and has a wide range of clients. He provides consultancy for many companies in the UK and overseas on subjects ranging from applying IFRS, project appraisal, through to ethics and fraud prevention. He's the author of a range of texts on accounting, auditing, and project appraisal. He's a regular contributor to CCH, CPD courses, and publications. So today's session, in a high-level canter through, we're going to be looking at responding and reading to, reacting to UK and global economic issues, changes to UK GAAP, FRS 102 and IFRS, new and revised auditing standards, supporting and improving accounting functions using AI, corporate governance, including ethical standards. That's about it for me. So, Ralph, I'm going to hand over to you, and I'll see you all in a couple of weeks' time when we're next back at the K3 Hub.
Thank you very much, Marie. Thank you. Good morning. I think you've enough of my background of what I do. I mean, rather much, it would seem. Just to say, the first thing is I am just retiring from auditing. There comes a time, age, sight, and so much regulation. But anyway, time soon to retire from auditing, but I still have my interest in project appraisal particularly, and I think there's interesting areas on construction contracts. It's something we'll touch on when we look at UK GAAP FRS 102. So that's more than enough about me. Let us move on. And here is the list of topics we're covering. Briefly respond to UK and global economic issues. That should really say going concern, because I think it's an issue I'm afraid that we're going to have to look at a little bit more in the year ahead. Let's hope not, but I think it is. Corporate governance, more on governance than ethical standards. I think you all will have enough of ethical standards. I presume professionals in whatever profession or professional body, we have to study ethics these days. Accounting standards, UK GAAP, and the two particular sections, IFRS, amendments and proposals. Nothing major there, but again, always things coming up. Audit, new and revised standards. And last of all, but during the course, I'm going to touch on AI claims, etc., for improving accounting. We all have our views, but AI can be very helpful. I think that's enough on that. We're next going to do two questionnaires, two quizzes, and not really for my interest so much as to focus the course, but they will help. But just, I hope, for your interest. So please do answer. So turning to the first quiz, what do you consider as the prime concern for your clients that you're going to face in 2026? Finding and keeping talent, sales, competition, the costs, or simply going concern. So over to you. What you consider the most significant? Right, very interesting. Yes, finding good people we see in the press and everywhere is important. Interestingly, on sales, that normally I think often would be their thing, but there we are. Competition, should we be worried there's not competition? But costs, absolutely, costs are with us. They never go away. I am in a way surprised that that stands out at this time. And good to see that going concern isn't, so critical for you. So I hope that's of interest to you. Let's finish with that one and move on to the next one. What do you or your clients consider as the most advantageous opportunity for 2026? Single choice, please. Interesting. Sales, exports, the second one down. Again, following from the first quiz, actually, okay. New products, yes, that ties in with sales and services, and a little bit more important, cost reduction's fallen away. And AI, well, I wonder if it's that because AI promises so much, and it does indeed. It promises a lot, but I think the question there is, will it deliver? But I hope that's of interest to you, these two quizzes, just to set the scene of what you are, business people, you're seeing the world at work. I hope maybe our politicians pay attention to these sort of issues. But there we are. I hope that's of interest to you and works for you. Let me move on. As I said, the first title was responding to UK and global concerns, and following on from the quiz, I mean, going concern doesn't seem to be too much of an issue for you, which is good, or your clients. But it is very much an accounting auditing issue, and it's maybe auditors that bore on about it far too much. What I did want to point out was it is a requirement of governance codes, it's a requirement of law, it's a requirement of accounting standards, and of course the auditors will always go on about it. We have, though we're absolutely sound and see no problems, we have to consider going concern. So this session looks at some extracts from the going concern basis risk guidance from the FRC. There are a couple of papers, in fact, and these are referenced on the following slide. The guidance considers the related requirements of provisions in accounting standards and the code, the governance code, which require disclosure, and company law. What I would say, if you think, oh, right, he's just going to go on about going concern, well, I am, but the going concern review ties in very well with strategic review. It in a sense brings together, it could be used certainly to bring together issues facing the company, sales costs, etc. So the introductory slides, I mean, what is important to you? And if it is cost, then that's going to say, right, to be a going concern for sure, we need to reduce costs, for instance. That would seem an obvious sort of area. So what do we have? The guidance considers the related requirements of provisions, accounting standards, code, etc., and the company law. What is interesting about this report is, and I know you all come from different backgrounds, and some financing, some operating, etc., different advising clients, a great range. My innocence, I don't know. I was surprised to see that the paper, the FRC paper, started in this way. Directors should consider the threats of solvency and liquidity as part of their assessment of the principal risks and uncertainties faced by a company. Well, obviously that is the case. It's something you discuss, but normally I see, and probably this is an auditor, you dive into, are you going to have sufficient funding, sufficient business, etc. But these headings, maybe you use them, but if not, they are sensible headings, particularly an area of going concerns and your strategic direction, if you like. So what actually do they cover? Solvency and liquidity risk may be so significant they may highlight material uncertainties and may cast significant doubt in the company's ability to adopt the going concern basis. So quite good headings to start with and start your discussion in any meeting on going concern generally, but the business generally. These material uncertainties must be disclosed in accordance with requirements or provisions of accounting standards and the code. So you would actually use these headings and say we have no solvency or liquidity issues. And I mean, I must say I haven't always seen that in accounts. Certainly, smaller private companies may not think this way. Solvency risk. What is it? Is the risk of the company, and this is not my words, I mean, this is a definition from this FRC paper. Solvency risk is the risk of the company will be unable to meet its liabilities in full. And then, to me, an obvious statement, a company must generate sufficient value that its assets exceed its liabilities. Fine. A failure to do so could render insolvent, logical, straightforward. The assessment of the solvency risk over the longer term involves considering the sustainability of the business model and the maintenance of capital. And that again, I think this whole idea of looking at solvency liquidity is a very good way, a good way of having headings for you are looking at your strategy and, as I say, the business model. Business model words have been bandied around now for what, 5, 10 years. And a very good pair of words. What is our business model, and are we honest about it, if you like? But enough of that. Solvency risk we know about, very important, tied in with our long-term strategy, if you like, our vision. There, that term this year, funny, in reading all the papers, thank goodness, vision has disappeared. I was amused by it and wrote, in fact, I think in one book I did write, vision, the definition from a dictionary is something seen in a delirium or trance. And I mean, that to me is a vision. It's this idea of our CEO or whatever having a vision. You could say, well, get the doctor, whatever. But no, the business model is a very good basis for things, and solvency as a topic heading, a good one. Liquidity risk, we maybe think about more often and more. We would first think about, I think, as an auditor, talking to clients of going concern, it's going to be liquidity. Is the risk that a company will be unable to meet its liabilities as they fall due? Is there a risk? And again, here we have it, the company must generate and retain sufficient cash to allow it to meet its liabilities. And that is often, when we talk about going insolvent, the company could be on the face of the books, the balance sheet, highly, apparently solvent, but the liabilities and assets just are not cash-like, and we don't have enough cash to pay the bills. If we can't pay the bills, that's it. One would hope you could borrow against your excessive assets, but again, tough times particularly, that disappears. What in good times, oh yeah, borrow more, go for it. What in difficult times happens is, of course, we have assets, but well, okay, but they're again, a bank, the financing people don't see that as really, it's not liquid security, if you like. The liquidity of an otherwise profitable company can be threatened if it is incapable of converting assets into cash. That's what I was saying. The assessment of liquidity risk may need to take account of potential short-term fluctuations in the company's working capital requirements. Again, I think as finance people, all of you are running a company or financing or supporting a company, we know that too well. And then again, this potential for short-term fluctuations is always with us. So liquidity is something the auditor might focus on first of all, and we absolutely need to day by day. But as I say, solvency is an interesting one to look at too, as the overview, if you like. Assessment, the adoption of the going concern basis of accounting. And this is my point, that it was my picking up my point, I should say. You all know this. Going concern wasn't a major feature on the poll, but we must do this assessment because of law. All companies must assess the appropriateness of the going concern basis of accounting. Companies are required to adopt the going concern basis of accounting, except, and I've made it smaller print, except when they're going bust. And, you know, so you are either adopt it or not. The next 3.3, the heading from this guidance I found interesting. The threshold for departing from the going concern basis of accounting is very high, as there are often realistic alternatives to liquidation or cessation of operations. Such realistic alternatives can exist even if they depend on uncertain future events. That, to me, is not right, one might say. Uh, you maybe have to depart from going concern, and there's no other option. But this idea that the threshold is high, I do wonder: are there uncertain future events, and are there realistic alternatives? Something to discuss. I mean, I'm sure you do at boards and with boards that are there alternatives? But I find that one rather interesting. And I just touch on it now. You may remember at the time of COVID, it was again the FRC said you're not companies just to say that there are uncertainties due to COVID, and that gets you out of things. So you can't just willy-nilly say something. And again, there wasn't, I don't think there was the loss of companies during COVID that there might have been. Again, apparently the government, and with clients I know and people I know, the government was exceedingly generous. And as we have some saying today, maybe too generous. So three is an interesting one. I'll leave you to ponder. You may absolutely agree with it. I think it's. I wouldn't make that statement that the threshold is very high. The threshold is there. Very much varies for different sectors, types of business. When making the assessment, directors might apply significant judgment. Now, why I highlight these are not me writing these. This is the FRC in this case. And when making the assessment, what are they saying by might apply? You are going to apply significant judgment. We are a business with guaranteed income for whatever reason for the next 5 years. We have an excess of assets over liabilities. Cash has to flow because people pay up front. What's the problem? Well, you don't need much judgment to come to your conclusion. But what I think you do have to apply is significant judgment. And towards the end of this morning, I want to look at judgment, because certainly as an auditor, in the accounting profession, we get, again, daily, weekly, often, notes and reminders about making judgment. There are papers on judgment, and we're meant to do it properly. So what do we mean here? Judgment about the determination of assumptions used in forecasts. So this absolutely, are the forecast assumptions sensible and evidenced? That can, to use another topical word, can they be evidenced? Judgments on the determination of whether the going concern basis of accounting is appropriate when there are material uncertainties. And we're going to look at that below. The assessment should be sufficiently robust and documented in sufficient detail to explain the basis of the director's conclusion with respect to going concern. And that, again, is what your auditors are going to ask for. And I mean, I have to say, with small private company clients, you don't get. Hopefully, in most of the cases, there's good reason that there are not problems. But this documenting things has been and is, and forevermore will be an important issue, that we have evidence documented, or documented evidence. What we might not think of, but accounting standards require directors to assess the company's ability to continue as a going concern. So it's not just the governance code or other papers, it's accounting standards as well. As a part of their assessment, directors must determine if there are any material uncertainties. And I'm going to pick up on this business of material uncertainty. Different terms are used, and they do have slightly different meanings. So I think material uncertainties would be a term used with COVID. There were uncertainties. And looking to the future, with the economy, there are, I think, for 2026, there are in lots of areas material uncertainties. So the directors must determine if there are any relating to events or conditions and that may cast significant doubt, etc. In performing this assessment, the directors must consider all available information about the future. Well, that makes sense. Events or conditions could result in the going concern basis of accounting being inappropriate in future reporting periods. So not now. In assessing material uncertainties, directors should also consider the realistically possible outcomes of events and realistically possible mitigation. Now, the problem with all the pronouncements and even the accounting standards and more so the auditing standards, they really do use, I would call it loose wording, but words that can be interpreted over a range, a spectrum is a word they like to use, yes, a range or a spectrum. The one what I'm getting at here is, what does this mean? What realistically would mean to one person might not to another? I always like to quote the example in the accounting standard, sorry, the accounting standards, but it's in the auditing standards certainly, is the word proper. And I actually did ask and got a very prompt answer from the FRC on this. I question the use of the word proper because my story is that a very good American friend, he's an engineer turned patent attorney, lawyer. He changed his profession as I did from engineering to accounting, auditing. We were having a discussion, something, and I at one point said, "Oh, that's not proper." And he immediately said, "That's what you Brits say when you're losing the argument." And it's absolutely true. What does proper mean? We do it. Oh, that's proper. So when we have words like proper assessment, what is proper? And the answer is it's used in the everyday use in English was the reply I got. And all I was saying is that it's a word that's maybe vague. And this realistically possible outcomes, can we express it in a more certain way? I think it's over to us to define in our terms what realistic means. And I think we have to do that in a proper manner. So words, right. Then we have uncertainties relating to such events or conditions are considered material. So we have different types of uncertainties, if you like, but they're also considered material if the disclosure could reasonably be expected to affect the economic decisions shareholders and others would make. So we do need the, I was going to say, stand back measure of materiality. Materiality is very important. If the events and the effect they have is not material, then there's good reason not to disclose. But more importantly, if uncertainties are material, then we must disclose. That is really what this is saying. I will turn to my script and just make sure I'm not missing anything from you. The magnitude is very important. The magnitude of potential impact of the 7 future events and changes in conditions and the likelihood of their occurrence. So there we have likelihood now. I mean, again, words, that one is a bit, you could express in percentage, there's a more than 50% chance it will happen. There's an 80% chance it will happen. But materiality and magnitude, there's a similarity to the thinking there. Magnitude sounds really more terrifying in a way. So again, in documents produced, I do think a lot of them could be edited down, but we have materiality considered and large materiality, magnitude of facts. The realistic availability, again, with realistic, and the likely effectiveness of mitigating actions. So they've got to be mitigating actions that are doable, and they might be doable, but they're not available just now. So, gosh, really at a board meeting, and I've seen this when you start using these documents as a base, you can really go off tracks of trying to define words, but you have to. I really do believe you have to be very clear what these terms and the range of the word means to you. just as you would materiality. Materiality, 10% out or less, not really a problem. 10 to 20%, you've got a problem, and any more, you really have a problem. So materiality, and we'll have our own views on this. And materiality for one figure could be a lot lower percentage than for another. It depends on where it is in the P&L account or the balance sheet. But all these words, and there's a lot to read here. I'm not going to read more. Well, I will. I want to finish with the bottom one. Whether the uncertain future events, the conditions are unusual rather than occurring sufficiently regularity. This is excellent stuff, good writing, but we need, if I were conducting a board meeting and considering going concern, I'd really pick on these words, ignore them because of duplication, or the point they're raising is very important. I would then make an effort to define what the word means in our context and get agreement of fellow board members or the company board members. So lots of words, lots of sense. The assessment period, there's slightly different definitions between the accounting standards and company law and auditing standards and IFRS and the code. So you actually, what that slide is showing is that for accounting standards, a minimum period of 12 months, FRS 102, at least 12 months from the date of the financial statements being signed, or sorry, authorized for issue, I presume signed. IFRS accounting standards, a period at least 12 months from the end of the accounting period, which is weaker, really. The code, that's the governance code, requires companies to consider a period of at least 12 months from the date of approval. So that's the actual approval again. And authorized ratio, I guess, is similar. It is similar. Determining the appropriate assessment period is a matter of judgment. So we have this that we do have to judge. And you must judge for more than 12 months because you're going to be gathered together to sign the next year's accounts. And it looks rather silly if it's insolvent and whatever. Something really severe has happened. So the assessment period, generally the 12 months from, I would say, from the date of signing, because you don't know more than to that date, but looking at a longer period as necessary. Here, again, I should have on introduction said, the slides are there for you just, if there's an important point, I hope you just go back to them, and if you've got the PDF already in front of you, but you go back to them and mark, or you're going through this, you mark page slide 16, and you can go to 321 listing ruling. They're there as sort of guide of where to find things. You haven't got a wodge of notes because it's rather silly. If I produce notes, I'd just be producing chunks from auditing standards, accounting standards, etc. So there on slide 16 is quite a few more points. Required disclosure from the company is not prepared on a going concern basis related to events. About I'm reading it very quickly myself. There's significant judgments, assumptions. I don't think there's right. I knew there was something here that I wanted to pick on, and I really should have another slide following this. 323 is very interesting. Well, it sounds interesting. Why I didn't produce a slide was I thought it wasn't interesting. Is 23 says there are 4, and this is guidance, so it's not the law, but it's important when a regulator gives us guidance that we pay attention. There apparently are 4 reporting scenarios following from the director's assessment. I thought, well, what the devil are these? Well, one is you are a going concern. Well, so what? You are, that's great. There's nothing to worry about. One is another one is you're bust, you're insolvent, you're not a going concern. I thought, well, that's obvious. And right, we abandon the meeting and that's it, folks. So what are the other 2? And they are interesting for your discussions on going concern and thinking about your business model. The 4 scenarios are really, the middle 2 are going concern, obviously requires judgment, and going concern, but material uncertainties. So there's a difference between them. So directors must consider whether additional disclosure relating to going concern is due basis of accounting, and any material uncertainties are necessary to be reported to present a true and fair view. This comes out, and I didn't go on about this. I'm always, as an auditor, sorry to see true and fair being sidelined, because it absolutely is by the international auditing standards. I mean, their definition is simply that no significant errors due to fraud or misstatements. That's a very limited definition. True and fair to me captures things well, but as I was qualifying and going through, true and fair was pilloried for being too vague. I think it can be defined very well, and certainly I think it's a good concept to use. What are these accounts? True, not fraudulent, not lied, not deceitful, whatever else. And are we showing the figures not in a way of netting off and hiding things? So true and fair has meaning, to me at least. And true and fair view is still in company law. That's the important thing, which, again, the auditing standards and the application of them, they have to deal with this. That our company law does still say accounts will be prepared and they're either true and fair or not. So the true and fair view really gives rise to these issues on going concern. Are additional disclosures required? Because that is important in the code, all the authorities that speak on going concern, that you must make additional disclosures where appropriate. And these can be for two reasons. Material uncertainties, do you disclose them? This involves considering additional company-specific information. In some circumstances, there are grounds for disclosure beyond explicit reporting. So what the four scenarios are, and if you want to see what they are, do look at this going concern guidance that the FRC has produced. It's the middle ones, the two that have a different emphasis about what you disclose, material uncertainties or not. And yeah, some circumstances grounds for additional disclosure. Disclosure is a very important thing. Again, you may take legal advice on that. I mean, and I think this is why an example again is COVID, that the FRC was saying, well, it's just too easy to say FRC there are material uncertainties and leave it at that. I mean, what does that or what could that mean really is important. So now another quiz. Enough ongoing concern. So here is another quiz. Right, this is a state of the nation question. I mean, this is all done anonymously, whatever. So had to seriously consider a going concern qualification, had a going concern qualification in the accounts, and foresee the need. I am surprised that the bands are more or less equal. I thought where we are in 25, there would be no need for any at all. That's interesting. State of the times. Take from it what you will. Again, like all surveys, how representative is it? This is you are a special audience. So yes, it's not interest. I think that's interesting. I don't know. I'm interested. Chat with you. I always wish these were live. We could have a little bit of a discussion here. But interesting to me, that is interesting. Right. Let me move on from that. in summing up, I was, as I use the term, boring on quite enough about going concern, but we have to deal with it. And from what is up there, you have had to deal with it. You've seen it, if you like, in practice. So the disclosures required. I mean, one, it's difficult enough. Is it? Are we bust? That's an easy one. Are we going to say that's an easy one? It's the middle that is difficult, and the determining which disclosures and the other point is, of course, how much is important. So this again comes from the guidance and may be useful process. Identify risks and uncertainties, including those relating to solvency and liquidity. So that's where we go back to where I started. You might have solvency and liquidity as different headings. What are the risks and uncertainties? There might be none under solvency, but there could be under liquidity. And I think that would be often the case, that the company is not insolvent technically. I always like that word, not technically insolvent, you just don't have any cash. Liquidity could well be the big issue there. Determining which of the identified risks and uncertainties are principal. Now, that's not my word. That, again, words are bandied around in the standards, all of them. And they're appropriate words, but some, I think, are dubious. Dubious. They have a range of meanings, certainly. Principle is a good term and appears in guidance notes and standards. So one thing is a principal risk, and then that's a maybe way of classing things. We have this principal risk. The business model has always had a principal risk. That it's a sensible word to use. Other process actions, considering whether it is appropriate to adopt the going concern basis of accounting, is what you're coming to. Considering whether there are material uncertainties that require disclosure. So that's different from principal risks. And considering whether disclosures are additional to those explicitly required by law. So I don't say it's a checklist. It's quite a good slide for a meeting. There's something, if I had time next, as I say, I'm winding down auditing, so the going concern discussions are, maybe have to sit in as an advisor in another capacity or whatever. Good idea to produce not a checklist, but a pro forma from all of these slides as to just how you deal with going concern. So, I mean, I hope this has been of some use to you. It is a walk through all that's there. The guide itself, the FLC guides, may be the one to look at, and you might want to pre-see it. So enough on going concern and the state of the world. Let's hope we don't have too many issues in the future. Right. What I wanted to do now was just look at the recently revised, and it's not a complete rewrite or whatever, so it's not a new issue. It's revised, updated governance code of January, I think this year it came in. Just to remind you what it has in it: the board, leadership and company purpose, division of responsibilities, composition, succession and evaluation, audit risk and internal control, and remuneration. And it's the audit risk and internal control that I want to particularly mention. It is forever a problem, I think, for an auditor, particularly of a small private company, but private companies generally, which maybe do not have external finance. I can think of one client I ceased auditing a year ago. It was a hugely successful company, totally private, asking them, do you have a manual? Well, you don't want that, the control manual. Do you have some notes on? Well, no, but do you have a page on internal control and risk? And the answer is no, because they run the company well. It's grown. I mean, this company, I'm thinking of 35 million turnover, highly profitable, excellent internal controls, but not documented. This is, to me, is forever a problem with the auditor, and we have to ask and often help them, but they have to come up with their assessment. So that is an important area, and that has been strengthened, if that's the word, The governance code, of course, is voluntary. Yeah, that's what I would say. I mean, it's you know, if you've got to comply, but say why you don't is, and it still remains that. I'm sure the likes of the FRC and others that are involved here would like it to be mandatory, and this was the this I think remains the idea of the previous government to have agra. I thought it was agro, but anyway, it was agra something. You know, it was going to widen the remit of regulation to include regulation of boards and directors, etc. Um, the retiring government last year, the year before, they backed off. The present government seems to have backed off too. I see just today, dear Farage, he's saying he's going to do away with regulation. Hooray. And it's very interesting that Labour are very keen on reducing regulation that prevents entrepreneurship, etc. So different views in politicians. But the governance code is voluntary, as it were just now. Comply or say why you don't. But audit risk and internal control seen as a area that needs development, and dead right it does. So what some extracts from this is what you're getting here, really. A successful company is led by an effective entrepreneurial board whose role is to promote the long-term sustainable success. I'm not going to read it all because it just goes on with the generating value for customers, contributing to a wider society, etc. The board should establish the company's purpose, values, and strategies. Personal view is I can't stand purpose, values. I love strategy. Purpose was dreamt up by the sidekick of Microsoft founder, and it's a good term, but it's far too vague. What's the purpose of a company? My view is, in the last book I wrote, the purpose of a company is to make a return on investment. That's it. Sorry. And yes, I will have values, and we certainly need a strategy. So objectives, make a return, strategy, put it into place, tactics below that as to how you go about doing that. But these are traditional, the topical words. It'd be interesting to see, it would be interesting to see in 20 years' time what words are used. Governance reporting should focus on board decisions and their outcomes in the context of the company's strategy and objectives. So we come back to sanity. The objective to make a return on capital employed, not enslaving people, not having health and safety issues, not doing anything wrong, having good values, but the strategy is to actually make a return. That's their objective. So lots of words. I said I wouldn't read it, and instead I'm warbling on about it quite enough. It was 2024 revision, came into effect early 25, is a limited revision. It particularly addresses the impact issue of internal control. So there you have it. The FRC has devised a principles-based approach which makes clear the board's accountability for effective internal controls through a declaration of, etc. The word principles-based is used endlessly. Accounting standards are meant to be principles-based. They used to be in Britain. The IFRS, they say they are, and they are really, but they become very much rules in detail. The auditing standards are rules-based, but we never say that. They are undoubtedly not principles-based, but they say that. And I think the feeling is, as long as you keep saying principle-based, that's what they are. But a lot of our regulation now is rules-based. And is that a good thing? I think it prevents thinking, frankly, but there we are, personal view. As a result, the code will provide a stronger basis for companies to evidence the effectiveness of their internal controls. And that's good. I mean, that's good for the company. Not forget your auditor. I'm going to say, forget the investors. That's why you're there. But for the company being run, it's good to have evidence about the effectiveness of internal controls, thereby enhancing transparency and investor confidence. Absolutely. In order to give a company sufficient time, we've delayed it till January 26th, the implementation. But again, this is, you don't have to do this, but you've got to explain why you don't. And all I'd say is I think the internal control issue is a very valid one, and for all sizes of companies, also for small companies. Needn't be big. I mean, a page might well do, but it reminds the owners, and a good thing to say to owners of small businesses, oh, you don't have anything. Well, I'm retiring soon. I'm selling my company. Well, you've got something else to sell, is that you've got a good governance code in place which considers internal controls. So to me, good stuff. So what we're going to do now is look at the section 4, which focuses on audit and internal controls. So again, I'm turning my pages. I need to keep up with my, in case I've written some notes here, which I have. The principles for risk and internal control: the board should establish formal and transparent policies and procedures to ensure the independence and effectiveness of internal audit functions, if there are any, and generally the integrity of the financial and narrative statements. The board should present a fair and balanced, understandable assessment of the company's position. The board should establish and maintain an effective risk management and internal control framework. And again, actually having more on risk and internal control means you can have that's a basis for a sound, effective risk management and internal control framework. So the principles are good and clear. 28, the board should carry out a robust assessment of the company's emerging and principal risk. So this is risk generally, not just financial accounting risk, internal control. And I'm sure they do. And then again, they'll be doing that, going back for internal control. They'll be going back to going concern. You, of course, have a robust assessment of emerging and principal risks. The board should confirm in the annual report that this has been done, including a description of the risk, etc. The board should monitor the company's risk assessment and internal control framework and at least annually carry out a review of its effectiveness. So stuff that you do now, sure, but it's spelled out again, if you like, there. Board should provide in the annual report, what should you provide? A description of how the board has monitored and reviewed the effectiveness. So again, I use the word manual, a dreaded term. Where's your internal control manual? It's, that's the kiss of the death to thinking and actually doing stuff. But no, you need papers, you need something written down, you need a manual of sort or pages. A declaration of the effectiveness of internal control, and that's an interesting one. How do you demonstrate that? The lack of errors and issues in the year. You could measure and you could report failures of the accounting system, a coded way, colored, whatever you are attracted to. Green, we've had a good year, just one minor thing. Orange, well, we've got to look at things, and red, we had a real problem. But how you declare the effectiveness, how you measure and report the effectiveness is interesting, and there are ways of doing it. A description of any material controls which have not operated effectively. So this is now picking this up as at the balance sheet date, the action taken or proposed. So I'm probably speaking to the converted, and I'm probably saying the obvious. I'm sure, and I know even, again, small companies do capture failures and say, well, it was a unique one-off failure. I think I'll just say something else, which I found very interesting in the last year or two, is audit programs, the published ones, and audit thinking is that with materiality, you've got to set materiality and you decide what is most appropriate. Is it on sales, big 1% of sales? Is it 5% of profit? Is it on asset base? And you'll look at all of these, and then you'll come to a judgment that something that's 8% out is or more is material, and you have to do something. So that's well established, but the programs and the thinking still has the term trivial in them. So to say, what is your level of triviality? And I mean, for companies, additionally, we set it at £500, £1,000. I frankly think this is a nonsense now, and I'll tell you why. For this good company I audited and another, their systems, the company I was mentioning, nameless company, they receive most of their income via credit card payments by members of public and companies to have services of reports and search for information for a month or a year. The payments are always in advance. The credit card system has to be robust. Of course, it could fail, but you've got great segregation of duties in the people taking the money are one of the global international credit card processing companies. This goes to the banks, which banks can make mistakes, but have really strong processes and are independent. The recording comes on data on individual computers, which is captured by one department totally and monitored and kept separate from the accounting function. The accounting function really just bring the stuff together. They don't input figures as such. There should be no error. That's my point is that, and even a small company with a good accounting system today, there should be no errors. Bank fees going in, they were ropey when a lot of software started a few years back, but bank fees tend to be absolutely right. And if they're not, you can soon pick them up with a bank reconciliation. The point is that this idea of a trivial mistake is a bit silly, I think, today. Just a thought for you, because things should be right. And for this particular company, I had picked up there's a difference of 38 cents or something. I mean, so this is nuts, whatever. It through the finance director and her team, super team. So, oh, what's this or whatever? They couldn't believe it, but there was a clear explanation. But the point was they absolutely accepted this is right. We should not have a 38 pence or cent was error. So something to think about. Measuring your accounting system. Hopefully, it is not a difficult thing to do, and hopefully we don't have too many errors. Right, what we're going to move on to is, and I got there very quickly, not quickly, I'm on time, just a little bit ahead of the game. We're going to move on to Section 23, revenue from contract with customers. I didn't say at the beginning, my plan was to have a coffee break now, and we're 2 minutes early, but never mind. We have a comfort break of 15 minutes now, and then we'll run for an hour and then have a 10-minute comfort break. So that's the idea. We'll stop now till 10:15. We're getting an extra 2 minutes there. And we'll then run to 11:15 just about and have a short comfort break and then conclude. So let's have a break now. And what, by the way, I'm going to try and look at any questions and comments made or questions. I'm not doing this as we run live. I'll have a look now. I may pick up and speak after the break, or I may leave them to the end, or in fact, it depends how many you get. I'm happy to correspond or reply to people afterwards. We'll just see what comments and questions we have. So let's have a break. Thank you very much. Welcome back. A few seconds to go. Do ask questions, raise points. I have a couple I want to answer. Both very interesting. Well, one first, Gavin, I think it is, got it absolutely right. Quiz. The quiz on have your clients recently, the third quiz it was in fact, have they recently had going concern, whatever. It's not a good quiz in the sense that you all came up with answers around there being a going concern issue. I didn't actually say there was absolutely none. So what I need to do is to look at how many people polled and assume the rest were all had no problems at all. So thank you very much for that, Gavin. And in fact, I have to say, last night I was going through this, and on it, I've got it written on it, RCT, sloppy, and maybe that's what I meant. So forgive me for that. But the point was, no, I'm not it can't recover from not producing a perfect quiz. A point is that out there, may be one each, of course, had issues with going concern slightly or whatever else. So that may give a false reading. The other point was that company, interesting one, company need for a qualification where the company is a going concern, likely to be going concern, but is up for sale. Do you need to report that? And I was asked for my views. My views are, well, first question would be, has it been published as up for sale widely? Then, of course, people would know. And if that's the case, well, it's a going concern, it's a going concern. And of course, that's one of the key points, positive points for a sale. So say nothing. Or if you want to be very good, say that it is up for sale, but so what? Because it's a going, it's a going concern. When I say, to me, it's a non-issue, I've been inclined to say nothing. But then you'll all be saying, gosh, what kind of auditor is he? Interesting question, though. And apologies for the poll on going concern. It may have given an over-negative view. However, let's get on to section 23. The section 23 and leases have come in UK, where you have UK produced accounts, FRS 102. It was a completely rewritten section in the 2024 review based on the principles of IFRS 15. It's coming into effect next year. Is it of significance? And the answer is, well, to some, very little. To others, quite some significance. So what I want to do, I mean, you can read the standard. You may have been in a seminar on this already. How much you get involved, you certainly need to know of it. But if you are in a particular sector or deal with a particular sector, then it could be very significant. You certainly need to know what's in it. And what I try to do is focus on the key elements of it and where it may be significant. So where it doesn't apply to leases, though leases are changing, this has nothing to do with the fact that revenue doesn't apply to them. It's a separate sort of exclusion. Insurance contracts are separate because there's an IFRS on that area, and that's special, really. It really is special. Financial instruments are covered, or should be covered well enough by the other sections, and the FRS 1 and 2 does refer to the IFRSs anyway, IFRS 9 in particular. Non-monetary exchange between entities in the same line of business and incoming resources for non-exchange transactions for public benefit entities. Specialism. So, I think the exclusions are ones that seem obvious. Yeah, I mean, they seem obvious. And in other words, the section applies to anywhere where you're selling stuff, revenue, you're receiving revenue. The primary issue in accounting for revenue is determining how much revenue should be recognized and when. And that's always been the case. And that is a very good summary. And in some of the following slides, I'm going to highlight that. What was the reason for the revision? It's more importantly, why was IFRS 15 ever written? I mean, I was involved with IFRS before it came into Britain. It was interestingly used, and the official accounting standards system before Britain adopted it. Look, the International Standards Board based in London, but it was adopted by other countries before Britain, in fact. So I got involved quite early on overseas with it. There were countries that discussed, should they have American GAAP, should they use UK GAAP, and or UK IFRS, in other words, IFRS emanating from the UK. So it's been around, interesting standard, and it's the FRS 1 and 2 sections based on that. The issue is accounting for revenue is this determining when and how much should be recognized. So the way it was adopted it seems ponderous, but there are 3, 4, 5 steps. 1, identify contract with the customer. Um, that's silly. If I'm selling goods over a counter in a shop, there is a contract, and this is an important thing. We wouldn't think of selling as everything sold under contract, um, but everything is sold under contract, and it's the old who makes an offer and who accepts the offer, and the company law that I suppose all of us, basic company law that we'll have studied way back. Um, there are contracts, of course. That for some businesses, construction is the classic. There are most certainly contracts for telephone subscription for a telephone service, including a free phone. There are contracts in there with the problem of there's actually two contracts, one for the provision of a service and the other for the giving you a phone, the provision of a phone. So it's not so silly at all. I mean, and for some businesses, the identifying and knowing the contract is important. The performance obligations, again, silly for selling something over the counter because the performance obligations, I give you the goods and you give me the money. I get the money, you get the goods, and it's all over. Identifying it for, again, construction contracts is a good example. When is an obligation? What is the obligation? Then determining the transaction price, again, simple for the shop sale, um, shouldn't be simple. You could argue it's absolutely clear for sure for a contract, but of course, prices change, and you could say it ties in with the obligation being delivered. Is are you due the price, if you like, because have you met the obligation? So the steps interact, in fact. And then we have a fourth one, allocate the transaction price to the performance obligations in the contract. Now, that's one where personal view is, I think the standard, the IFRS and 102, can make a little bit much of something that could be dealt with. Some allocating the transaction price, some would say for construction contracts should be difficult, but again, that it shouldn't be if it's a well-constructed contract and clear performance points are agreed at the start. So allocating transaction price can be an issue. The actual section gives examples that make quite a meal of it, maybe rightly so. And then you recognize revenue when an entity satisfies a performance obligation. So when you get the amount, the time, and the conditions right, you can recognize revenue. It really is quite a standard. The question I'll come to later, I've got some, and I want to demonstrate the power of AI. I use AI to confirm my knowledge and, more importantly, my prejudices. It's interesting. We'll come to that later as a sort of tie-up, but let's look at the different stages. At step one, an entity identifies contracts with customers that are in scope of the five-step model. So again, excluding the ones that are excluded. There has to be a contract. An entity must confirm that the contract meets the criteria set out in paragraph 23.7. The criteria indicate the contract establishes the necessary rights and obligations, and therefore means that the entity will be able to apply the subsequent steps. So there has to be a contract. If a contract meets the criteria at inception, reassessment is only required where there's an indication of significant changes. So there you have a word I could see coming up in discussion on construction contracts. We're not, the contract terms are there. Time slipped, money has gone up, you're due some additional money, but we're not changing the contract. But are there significant changes? And I could see arguments over have there been significant changes or not. So for construction or buying something over time, having it manufactured over time, yes, there definitely are issues, potentially. If contracts don't meet the criteria, example, payments in advance of a contract meeting the criteria are set out in 33.7, the entity recognised consideration as a liability until those criteria are met. That to me is dead simple. I mean, if you get money up front and you've done nothing, and whatever else, that you've got a liability in your accounts. You've got payment in advance. If a contract never meets the criteria, the entity recognizes the consideration received as revenue when the criteria are met. Well, if it never meets it, it means never initially it meets it one day, then they are met. Basically, when the contract is finished or terminated and the amounts received are non-refundable. That's good accounting. Ting. That's simply good accounting. I don't know what the ting is, but anyway, ting. It is good accounting. Receipts in advance, no work, nothing done, nothing delivered. That's a liability, but you owe it back. When you meet it, and the contract's terminated, finished, and the money is non-refundable. So, meeting the criteria, accounting for it, I think, fairly clear. Step two, you have to identify the performance obligations. An entity identifies them in the contract, obligations in the contract. A performance obligation is a promise to transfer distinct goods or services. So that's what an obligation is, a performance obligation. That's the term used. When a contract has more than one performance obligation, the subsequent steps of revenue recognition model aim to ensure that the revenues associated with associated performance obligations is recognized at the appropriate time. Promises may be implied by an entity's customary business practices. And that's another one. A lot of, because of an engineering background, railways and power, in fact, started off in power stations and things. A lot of settlement of amounts, there was customary practice. And there still is in these industries today. But again, as auditor, you needed to know what this was. I'm aware that I think things have tightened up. Terms and contracts, probably better worded, probably clearer than they might have been in the past. But what we've got to be clear on is the performance obligations and recognizing them at an appropriate time, and that's to both parties. That's where you get arguments. One party thinks one thing, and the other party. What I mean is, the seller thinks one thing, the buyer thinks another. So, but we'll come to that. So that's step two. Step two contains detailed requirements about specific areas: warranties, non-refundable upfront fees, customers' options for additional goods and services as material rights. These can be called that. And revenue earned as principal or agent. That's fundamental to determining how much revenue the entity recognizes, and is based on whether the entity controls a specific good before it's transferred to the customer. That shouldn't be difficult to find. I mean, do you actually control it? I mean, if it goes to your warehouse and you have control of it and sell it on, as it were, well, it's obviously you're acting as the seller. Whereas if you just deal with the paperwork and goods are delivered, you are the agent. I think the definitions there are generally quite clear, and the standard gives guidance. So there are some detailed requirements. Warranty is an interesting one, and upfront fees, etc. Determining the transaction price. The transaction price is the amount that will be recognized as revenue, and it's the amount of consideration to which the entity expects to be entitled in exchange for transferring goods or services, excluding amounts collected on behalf of third parties' VAT. So it's the pre-VAT price. I mean, that's clear enough. However, consideration promised in a contract may include a variable amount: discounts, rebates, refunds, penalties, etc. The entity shall estimate the variable amount in the transaction price and update the estimate at the end of for each reporting period. And this is where we have real problems with long-term supply contracts, construction contracts, etc., which have variation clauses in them for whatever reason. Again, from an auditing perspective, you've got to say, well, what does your customer think? If you're looking at revenue for a construction company, right, you think this and they think that. I mean, they should match. Again, whether you can be or are privy to what the manufacturer thinks is another matter. But the variable amount and getting the time aligned is one of the issues that's always been there. And it's one of the reasons for this section in FRS 102. there are two steps to estimating variable consideration. An entity shall first estimate the expected value of the most likely amount, depending on which method the entity expects to better predict the amount. Okay? The estimate shall only be included in the transaction price to the extent that it's highly probable that the entity will be entitled to the cumulative amount of revenue recognized when the uncertainty associated with the variable consideration is subsequently resolved, sometimes referred to as variable consideration constraint. And I mean, what's explained there is exactly what happens in long-term contracts. We have issues, if you like, not if you like, we do have issues. So let's make sure I miss nothing. On variable amount, I'm just considering when to say this or say this now or later. It's a point I make anytime I talk about projects and things. This question here, the most likely amount and highly probable, is very interesting. What is highly probable is defined in IFRS and in UK GAAP, for that matter, it follows. As probable is defined as more likely than not. That's simple. It means if there's a 51% chance of it happening, it's probable, but not highly probable. And highly probable is really, I explain simply, it's defined properly in the standard, but it's more probable than probable, more probable than probable, if you like. It's not defined with a number or whatever. And to me, a very good example of this was, what you consider highly probable depends on your viewpoint, obviously, may depend on your culture. And my story here is, I spoke last year, I may have different topics from last year, but may have mentioned then, I always do tell the story. I spoke to a group of Russians 10, 15 years ago when we were allowed to. I mean, there was some interesting work and things, but quite close. I mean, their bodies in Britain, government bodies, having discussions with Russians on accounting matters and whatever else. It was really great, and to meet and discuss things. Anyway, I had to speak at a meeting on IFRS 15 revenue because Russians were adopting these standards, obviously translated in their own way. The group, there were 15 of them, and 10 were ladies. So interesting view there. And the other point was these were chief financial officers, directors, even for some of the big Russian names, the oil companies, whatever else, gas. It was a meeting. We were in Barcelona, which was rather nice. Very bright audience. It turned out, of course, what another interesting fact was, I said, about accountants. And they said, oh, no, we're economists. They were all economists, but they were in charge of the finance function. And I said, but what about accountants? And they were just dismissed as bookkeepers. I thought, well, this is great. But anyway, but they knew their accounting. That's the point. And we came to the area in IFRS 15 discussing probable, highly probable. It was discussing when you would book variable income. And, I explained, convention, I think is the word I use, in Britain would be that if you had a contract where there was additional work done, variation income, which the customer had, agreed to. In other words, there was at least an email setting out that money was due, and an indication at least of the amount. When would you book this? And I explained the IFRS 15 says it's when it's highly probable. Well, if you had an email and the amount was pretty fairly defined, and the additional work to be done, the data and certification work was clear, then and you were auditing, because I met this as an auditor, you were auditing this, then you would be happy that they booked this if this seemed highly probable, that the whole the amount, the time, and what was done was all agreed, then it could be booked. But I discussed it when, if it's a bit vaguer, you've got the variation, you've got some writing, the customer wants the work done, the amount is a range, but you're not sure when it will be done and complete. How much, if anything, can you book? Well, traditional, I think, British convention would be this is potential probable variable income, and to be highly probable, you'd want to be 70% sure it was coming in. I think 80, you're pushing it a bit. 90, you certainly wouldn't. The Russian answer was, oh, we would book it. It's more than 51%. It's, to them, there just wasn't a highly probable was, well, it's probable is highly probable. There wasn't the thinking. This was from their economists thinking, let's get this right. They're not saying that Russians, and I've got Russian friends, we're not saying that they all think like this, but this was their cultural view of highly probable. So this must exist in Britain as well. And certainly it does. And this is to this day a problem with construction contracts. I mean, how much for highly probable income should you book? The very prudent person would book none, but you've done the work, you've got the costs, and you've no revenue to match against them. Okay, that's a loss-making project or whatever. It is and remains an interesting area, and it is not, in my view, helped by this concept of highly probable. That really does need to be defined. And again, I would do it in context of the particular type of work, the contractor, a manufacturer, long-term contract, whatever. It must be possible to define stages and documentation, for that matter, as to when things are done. On that, just stories which I hope help you, but if you're in this area, working on site as an engineer, nothing to do with this. Years ago, I was introduced to this whole idea of variable income and is it income? On a site, I would go around, and there was one chap was the quantity surveyor for the company, and would go around, and he had at that time a Woolworths, if we remember, Woolworths have gone, of course, well, truly, but whoever, Smith's little duplicate book, one of these books with paper and carbon paper copy, and he would go around, and when they did a site visit, a site inspection each week, go around, and because we were the main contractors on site, we'd always, obviously we're the ones to be asked to fix things. So fix a fence. It wasn't in the contract, but he said, "Oh yeah, we'll do that." And he would write down in notes. It was good to write it down, have this done, and he would ask the client, the customer, to sign it initially. And he had a reputation of just being a bit of a nuisance on this, going dancing like this. And you do this for everything. In one instance, the customer said, "Oh, we'd like hangers, called, holding pipes up." Said, "We would like those made of stainless steel, not mild steel, because they'll corrode." And he said, "Oh, fine, whatever," and wrote this down and got the signature. Does he not give up? Anyway, what came into play was interesting. This little story is more about project management. What it came into play at the end of a month, I, as a junior, but was allowed to sit in on the meeting discussing progress, and this included variable income and what was to be charged. And they went through, and he said, "Well, we've amended the fence." "Oh yeah, fine, whatever else." And then he came to this episode of the different stainless steel, not mild steel hangers, and the client said, "Oh well, we just said then that they would be better. We didn't ask you to do it." But he brought out his book, of course, and said, "Well, you did. You're dead right. You did." And we discussed. I think there was some mention that it'll cost you money. He had evidence, and they still went on. And then he brought out his book and he started putting down endless petty amounts on the table. So the whole question of highly probable should be less of a problem where there is good project management. Okay, forgive me to take all that time just to make a point you should know, but for our finance people, we really need to, I'm going to say interfere, but make sure the recording of whatever can give rise to additional income is recorded. And this applies to both sides again. It applies to the customer and the supplier. But the probable is a I say worrying term, one we need to be aware of. Section 23 does contain requirements for specific types of variable income: sales or usage-based royalties, refunds, and sales of the right to return. So I think those are actually clearer, but and in fact, it's good that Section 23 does cover these. Also, requirements for specific situations that could affect the transaction price. The time value of money, particular in payment, is expected more than 12 months after the entity satisfies a performance obligation, and non-cash considerations. The time value of money one, to me, um, yes, you may well do whichever side you are, but I think it's the person paying is really worried whether it's revenue or not. Yes, if you're promised revenue 2 years' time, that's not economically worth that today, then you need to note that. But to me, that because they're noting it as a management issue and a project issue again. That, all right, you're delaying payment for 2 years, and yes, we quite like the price, but of course you do realise you're not giving us 2 million, you're giving us 1.8 million. That to me is a negotiating project management issue first, not an accounting issue. But it is recognised here, and you don't have to do it. I.e., adjust the time value of money, but it's certainly indicated. We come to step 4. The entity allocates the transaction price determined in step 3 to performance obligations. If a contract contains a single performance obligation or all performance are met at one time, then that's no problem. The allocation based on standalone selling prices. Again, this is not for construction contracts. This is where you manufacture things and deliver at different times. Allocation is based on the standalone selling price of a good or service. The standalone selling price is the price at which an entity would sell a good or service promised in a contract separately to a customer. This is which does add potentially unnecessary complexity to bookkeeping. And this whole idea, and but of standalone prices. There are examples in the section, and there are examples, plenty of examples, if you like, in textbooks on the topic. But the standalone selling price is appropriate in some cases. I have a feeling it may be implied that it should be applied in more cases, more situations than necessary. If the standalone selling price is not directly observable, the standalone selling price for good or service is not directly observable. An entity uses a suitable, and again, one of these words, suitable method to estimate it. And examples are given: adjusted market assessment approach, expected cost plus margin approach, and residual approach. Accounting is so intellectual. Smiley face. Yes. This obviously shows you, and this is from IFRS 15. As Sir David Tweedy said, I mean, hijacked by, well, he said actually accounting has become an industry, but also, it's been hijacked by economists, hasn't it? Or others have said that too. There may be a case for an adjusted market assessment approach. Expected cost plus margin seems reasonable. I can understand that. Residual approach, interesting. Anyway, this points out, I've gone on enough about IFRS 15, IFRS section is maybe unnecessarily complex at times, but that's the way it is. So I mentioned to you, I don't know how much you use ChatGPT. AI is an interesting term, artificial intelligence. The two words don't go together. Artificial is totally artificial, and intelligence is something some people have or not. Anyway, it's called AI. That's enough on that, on words. And I chat with ChatGPT. My friends and family think I'm really sad and definitely on the way out. But it's interesting. Right at the end, I've got a little story about AI. We may not have time for it, but you can look at the slides right at the end. It's self-explanatory that AI is dangerous, but AI is very useful if you know something. It's very useful if you want a view confirmed or you want disagreement. So in this case, I said to ChatGPT, in my view, amongst all the issues IFRS 15 has in many IFRSs, illustrated here. This is talking about revenue recognition, etc. The one significant reason for it is avoiding revenue manipulation. And at this stage, absolutely, the section in 102 and IFRS 15, it's good stuff because, and if you think about right at the first slide we had, it really is about reporting the right amount of revenue at the right time. So there's what good old ChatGPT says. Oh yes, the anti-manipulation objective is arguably the real driver behind step 4, and particularly about this allocation. The conceptual package, faithful representation of value transfer is the theory, but the discipline enforces about stopping management from gaming of revenue. And that is absolutely it, that you allocate in the correct time period, because and we've seen it, construction companies fail. Why? The accounts were fine for the last 5 years, but they were getting poorer. Well, the answer is it's taking revenue in early, plain and simply. And I liked ChatGPT's term. It's gaming timing of revenue, and that is what the section 20 aims to stop. And it's why maybe I've gone on about allocation being complex. Maybe it does need to be complex in some situations. Step 5 then, once we've allocated, etc., we recognize revenue when or as the entity satisfies a performance obligation. Now, this again is open to this with for the allocation. In some ways, this one is maybe more commonly misused. The entity recognizes revenue, the transaction price allocated, so that's in it, to each performance obligation, etc., for when or as the entity satisfies the performance obligation. Performance obligations are satisfied by transferring the promised goods or services to the customer. The approach applied is decided based on how the customer obtains control of the goods or services, which occurs either over a period of time or a point in time. The approach taken for each performance obligation is decided at contract inception, or should be. And that's why, right back at the beginning, there should be a contract. And if you've got a contract over 5 years to supply goods, services, or if your construction contract being built over time, the contract really needs to be well written and clear. And the problem is, of course, there is one contract with the seller to the customer, and they both signed and I presume agreed to it. So the terms should be similar. In practice, what happens, for good, well, not for good, for practical reasons, what happens and billing goes out of sync, shouldn't be a problem, but it's where we get accounts that are not true and fair because there are errors and of course there's possibly fraud. So step 5, very important, and this section is very important. Will it solve the problems? It ought to, but it still leaves, with the words we have and highly probables, etc., it still leaves room for error. I would certainly use it if I were in a construction company as a finance person, as a stick with which to beat the project managers and the procurement people and everything else, saying, look, we need to get this absolutely right because steps 1 to 5 are coming up. So good stuff, really, but it's human, it has its flaws within it, if you like. Some more points on performance obligations and satisfied at a point in time really aren't issues. Determine the point in time. The entity has a present right to payment. Customer has legal title. The customer has physical possession. So that's selling your goods over the shop counter. They've got the goods. So, performance obligations being met. The customer has the significant risks and rewards of ownership. That's an interesting one. If you're building, let's say you're putting in a gas-fired power plant, you're a manufacturer of gas turbines, gas, whatever, and you're putting this in for a utility. Do you have the risks and rewards when you've got a half-complete power plant on your bit of land? You've got to take it to completion, but do you have the significant risks and rewards of ownership? Well, no, you're an in-between land. Customers accepted the asset. So at handover, you've accepted it. Yes, you definitely have sold. But so the satisfied at a point in time. This really points to some of it is it's never going to be a point in time. I mean, if you've got the risk and rewards, if it's one bit of plant handed over, but not if it's still being constructed, which leads us to recognizing revenue when or as the entity satisfies performance obligations. And this is the issue for construction contracts, etc. The entity recognizes revenue transaction price allocated to each performance obligation at step 4 when or as the entity satisfies that. So that's why in contracts you have delivery and testing, performance handover. Performance obligations are satisfied by transferring the promised goods or services to the customer. Same old words. The approach applied is decided based on how the customer obtains control of that good or service, which occurs either over a period of time or a point in time. The approach taken for each performance obligation is decided at contract inception. And this, again, maybe is a very, very, very valid point on the standard IFRS, but the section that the contract at inception, and a lot of sales are done under contract. This should be really understood and looked at by both parties and clearly obeyed, if you like, or clearly followed by both parties. So there's step 5, performance obligations. Yeah, this is some more thoughts on it. Physical possession, that's a duplication actually. Entity obligation satisfied over time. An entity transfers control of goods if the customer simultaneously receives and consumes the benefits. The entity, which is, I wouldn't say is over time, it's a point in time all the time, if you like. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced, and the entity's performance does not create an asset with alternative use. So again, this is from standard. This is trying to define, help define, maybe the first are obvious, but the third one is that the entity doesn't create an asset with alternative use, so it has to be owned and satisfied, and payment and enforceable payment follows, if you like. Right, on and going on a little bit, hammering this a little bit. The recognizing over time is the issue with construction, buildings, high speed 2. They've got plenty of time. That's a bête noire of mine. I write about it, but you've got plenty of time with HS2, a long time. An entity recognizes revenue over time by measuring at the end of each reporting period its progress towards complete satisfaction of that performance obligation. And that's an entity. So, and again, we have both entities doing this, recognizing the costs and recognizing the revenue, but we're talking from the sales here. An entity determines an appropriate single method of measuring progress for each performance obligation. An output method, such as surveys of work completed or counts of units delivered, or an input method, such as a measurement of time elapsed or costs incurred. I was going to say there's a minefield here. That's silly over dramatizing the whole thing. It's not a minefield. And appropriate's fine. I mean, because there are different choices. The entity determines from a selection. The output method, surveys of work completed or counts of units. Counts of units, fine, that's fine. Surveys of work. A classic in construction is the quantity surveyor, the architect's certificate. So you get a single method is reporting progress from an independent party, and that you're at a stage, so much work has been done, and you can book the revenue. A problem with that is that work completed, architects, quantity surveyors, for very good reasons, will have practice of recognizing a stage from a engineering or building architectural point of view. So you could have, I mean, as an extreme example, you could have an architect, and the practice is a house is being built, a room is complete, um, functioning, the wires, cables in, and everything. The door handles are not on. You don't recognize it as a working room, functioning room. And you know, dramatizing this if you like, but but fine. Next time when you put the door handle on next month, the room will be recognized, that stage of building, and you will be entitled to, as the original contract said, you'll be entitled to so much money, less a retention, another issue, but that's a contract issue. That's purely something's held back so that you make your room doesn't collapse, if you like. The What this means is that construction companies or the seller has done more work and has earned more revenue than is being booked by the system they've chosen. So nothing wrong with that. It's prudent and conservative, but it does, yeah, I mean, it's an issue. And then the end of a financial year, your profits aren't what you thought. Well, of course, we've got all that unapproved work. We've really done the work. We're going to get it approved in January. It's a December year end. Yeah, we can book it. And this is what this standard is meant to prevent. I don't think it's going to prevent that necessarily. And the input methods such as cost, time or cost incurred, that in a way is more satisfactory. That's from the seller's point of view. We've done work to date, cost to date are this, we can book that. Now, with or without a margin's another issue. We haven't had it certified, but our costs are only 95% of what we will charge as per the contract. I mean, the customer may not know of the cost, but they will have a good idea of the margin. But the contract certainly implies there's a 5% margin. 95% cost, can we book the lot? That's an interesting question on prudence or not. Maybe the more satisfactory method. So what I'm pointing at, this recognizing over time is the standard does not solve a lot of the problems. And you're still going to get construction companies collapsing. Yeah, that's really a positive outlook, isn't it? But there's very good reasons why it happens. Over optimism, delays. Well, I'm sure we all know that's just construction contracts. So a good standard, aiming to do the right thing, but there are simply difficult areas. What do we do as finance directors, investors, whatever, auditors? We try and ensure there's documented evidence methods that are complied with. And then hopefully we can end up with genuine revenue and a piece of working plant or whatever we're acquiring. Contract modifications, and really I've hammered this enough in a way, if hammering's the word. The problem with modifications is, are they modifications? Because a common fact, a common issue with a lot of contracts, the contract's progressing, your goods are being delivered, the plant is being built, the building's being built. The customer said, oh, we'd like you to do a little bit more there. We've decided to have stainless steel, not mild steel. Fine, contract modifications, variations. But the question is, whose modification is it? The ones you certainly do not call, the engineers, of course, will call them modifications because they've had to modify something, but what they're doing is correcting a mistake of theirs. I mean, that happens. That there was a tender, a bid, drawings, design, and when you come to build it, hey, it's not going to work. That's going to foul that thing. It's going to whatever, and that's our mistake, not the customers. So we have to modify. That is a cost to you. That's just a provision for your mistakes, if you like. But what we're talking about here is modifications where the customer makes them and they become variations, variable income. But the question again is, did they ask for it or have we got evidence? So questions, why does the modification arise as fundamental? Is it a variation, now using that term? Who approved the change? Is the change approved at all? I mean, that's the worry. I'm just seeing this from my time and present time, just thinking of provisions on contracts. Why do they arise? So contract modifications are mentioned. Contract balances, this may be a significant issue, assets, liabilities based on real or perceived progress. Where I hope it's not doom and gloom, just my points. And there is lots of very good project management, very good accounting, from a contractor's sense, from the customer being clear and satisfied. There's a lot of good work done, a lot of buildings built properly, and things work. So let me know. I don't want to get carried away, but there's plenty of scope in practice, accidentally or deliberately, to get things wrong. Section 20 does a lot to try. I think what Section 20 does is awaken us to the issues thoroughly. And where it all washes up in a way, of course, is that contract balances. In days gone by, you had contracts under construction, contract work in progress. The term now, and the standard pushes towards this, is you have a contract debtor for unbilled work. And that could still, of course, be dubious. And in past, it more likely be called contract work in progress. So you're not even saying it's ready to bill, but we've done the work. And that is vaguer. So today we should have contract debtors that are real debtors. Sometimes they'll appear in the balance sheet 12 months later. I mean, you've done the work, but the contract terms, etc., mean it's not going to come in until after 12 months. So the terms are clearly defined in the standard in the section, but whether how they're applied, it keeps going back to this scope, slack, this looseness in thinking, if you like, of customer supplier. Entities forming transferring the goods or service to the customer and the customer's payment amount of consideration received or due to the customer. That is the contract balances. Those words are from Section 20. This may be a significant issue, assets or liabilities based on real or perceived progress. So, I'm having praised, and I have to say that the IFRS 15 and this section do attempt a lot, but I think they really raise and expose the issues rather than they can't solve them. The solving them is down to good project management and good accounting, sound, regular, consistent accounting practice. So I'm really in sermon mode. Enough of that. Right. A quiz. Moving on to leased assets, something different. So here is a quiz. You're studying the answers. Well, dollars, no, because we don't operate in dollars. But funnily enough, I could be wrong, but the IFRS still, and it's not in the standard. That's the point. It's in the guidance to the standard. It's discussed in the standard. The figure there is 10,000 US dollars. Other jurisdictions may have hardened up on that. I don't think we have in Britain. I could be wrong. But I don't think I have. £10,000 possibly. That was mentioned. No limit. You did not answer this question. Popped up. Or you didn't answer the question. No limit. Zero. No. It's interesting. I thought personally, I was working on this before and putting slides together, thinking I thought it was the £10,000 they'd come up with. It's a lot vaguer, is all I'll say. And we'll look at the slides. What people would want to do here, and I just one client a day or two ago said this. I mean, I use the term that ChatGPT used. I think people maybe try and game this to keep from having to capitalize leased assets. The answer is bigger. It is not a sum of money. I had thought, I think it must have been, I was thinking of earlier drafts of this revision. They were going to be a sum of money, but it's not zero. I mean, it's not compulsory, absolutely, which I think that's the message that seems to have come across. Mixed messages. Hope I'm not giving mixed messages, because we'll look at what the we'll look at what the standard actually says. So, moving on, what is the purpose of this? Section 23 of FRS 102, capitalizing leases. Right. So I thought I'll ask ChatGPT, why should I have to think and write? So what it is the purpose is to set out the principles for identifying a lease, determining whether an arrangement contains a lease, conveys the right to use an asset, and it classifies leases either finance leases or operating leases. So I have to say, AI knows its stuff. I mean, this is absolutely correct. I think I'm going to say something now which might interest you, not for or against AI. I've got a silly little story at the end, which we may have time for or not, so you can read it. But I asked a question and to get an answer. And before I asked ChatGPT, I just Googled my question, and I didn't get the answer, which I was asking about an answer, but I got data about my question from Google. Okay, very clearly, very quickly. I asked ChatGPT and it ignored the fact that there was a database somewhere with knowledge of the question I was asking. I hope you're with me that why I'm saying this is I had assumed that AI, not just ChatGPT, really had access to everybody's database. And I certainly had assumed that it had access to the Google databases or whatever. It clearly hadn't or didn't search, and that was a worry. But on another piece of research, serious research, I had said something. I said, I actually said to AI, can you not look in Google or something? And the answer was, we do not use, and specifically Google's databases at all. So an interesting question. Some of you may know the answer. People go on at me, you shouldn't talk to AI, it's only learning from you. Well, good luck if it learns what I know. But and I hope it learns a lot of wisdom. But really interesting that there are very good databases. If it comes to accounting standards, ChatGPT or whatever knows its stuff. So there's, anyway, back on theme. The point is, leases are, I think we clearly know that we've got to capitalize leases or we have operating leases. Accounting treatment, finance leases recognize an asset. Sorry, accounting treatment for the lessees. Finance leases recognize an asset and corresponding liability. Operating leases charged to the P&L account. Accounting for the lessors, de-recognize the leased asset and recognize a receivable equal to the net investment. Operating leases keep the leased asset on the balance sheet and recognize leased income. So changes, they always say there's not significant changes for lessors, but there are changes. Disclosure requires disclosures to give users of financial statements a clear picture of the entity's leasing arrangements, such as future lease commitments and an income expense for leases. In short, the purpose of Section 20 is to ensure leases are accounted for consistently and transparently, good stuff, reflecting the economic substance, who really bears the risk and rewards of ownership rather than legal form. And that is the party line. But I did say, I asked another question. I said, this may make sense to an economist, but to a lessee, and lessor for that matter, the lessee knows full well they do not own a tangible fixed asset. And I actually feel this. I mean, AI on ChatGPT is thoroughly sycophantic. I mean, I just can't get it to disagree with me, which is annoying. But ChatGPT said, that's a really good point. And it actually gets to the heart of why Section 20 exists. Accounting standards aren't just about what business itself knows, they're about making sure that financial statements communicate that reality clearly to others, investors, lenders, regulators, in a consistent way across all companies. So Section 20 serves to bridge the gap between legal ownership and economic substance. And that's a perfectly true statement. A lot of us will have reservations. A lot of us will deal with clients who are running very successful businesses, who are really already are going to be hacked off by this accounting. And I still have sympathy with them, because, and one thing I bring in here, true and fair, if you have leased assets and you're showing them on your balance sheet as fixed assets, albeit with different as leased assets, is that true and fair to a normal thinking person? Are we not, with this economic substance, are we not pandering to economists thinking? We are. And then, but a very strong reason, and a lot of you there will be involved in investing and everything else. Oh, it's so investors understand. I don't think it helps investors. I mean, frankly, I would question whether a true and fair view is shown using this technique. But I'm not here to. You think, God, he's listening to this chat, this going on about his personal views. I hope I would love to be in front of you all chatting, and I could see your face, and if you're still all there, that is, I know how many were there. We would get visual feedback, and we could have some questions and discuss this. So this is my reason for doing this, is just to be provocative in the sense of we need to understand and have our answers. And yeah, I mean, of course, clients or whatever will comply with this. We also need to explain to the layperson maybe, and some investors are lay people, that what is going on. No, we don't own that asset, etc. So there we are. That's enough from ChatGPT. I think. Oh no, I can't give up. But the standard says forget the concept of true and fair. Yes, you've hit on the very crux of the debate about Section 20. Yes, more broadly, blah blah blah. So as I say, ChatGPT particularly is sycophantic. Yeah, you're absolutely right. Now enough of that. Right. Let's look at leases from the FRC fact sheet to aid preparers. This you might find useful. I mean, the FRC produces lots of good stuff. Fact sheets, it's, well, maybe as you know, you get reminders from them or emails from them daily telling you, but some things don't really pop up easily. This fact sheet is there to help preparers in applying the lessee requirements, scoping. Section 20 applies to arrangements that meet the definition of a lease, a contract, or a part of a contract that conveys the right to use an asset, the underlying asset, for a period of time. There are some situations where a contract that is or contains a lease will not be in the scope. That's set out in 21. Generally, they are set in the scope. Short-term lease is one that the commencement date is a lease term as defined of 12 months or less and does not contain a purchase option. This recognition exemption must be applied by class of the underlying asset. The assessment of lease term is discussed in section 4. So I think it's quite clear. I mean, it's got to be under 12 months. There's room for discussion around the option. Is it clearly a purchase option that you have and can use or not? And then the question would be, are you likely to use it? So there are issues there. Leases for which the underlying assets have low value. And this is where, as I said, I had in my innocence maybe from IFRS on leases, maybe I thought there was a definite amount, but no, the value of an underlying asset is considered in absolute terms, independently of an entity's materiality of the value. Section 20 does not specify a particular value threshold. Instead, it provides a list of examples of the types that are not of low value, including real estate and motor vehicles. So that's in a way is easier to do. It is not exhaustive, and preparers need to consider whether a leased asset is of similar value to those on the list. The purpose is to ensure the leases of significant assets are recognised in a lessee's balance sheet, whilst allowing leases of lower value assets to be left off. This recognition exemption can be taken on a lease-by-lease basis. A lease cannot qualify as a lease of low value if the lessee subleases or expects to sublease. So quite a lot to follow, but I think good news, I would read it as good news for those that thought, oh, every computer and whatever else needs to go on the balance sheet. Not so, but you need to study this carefully. The recognition exemption can only be taken if the lessee can benefit from the use of the asset on its own or together with other resources that are readily available. This means that it is not possible to keep a lease off balance sheet simply by breaking the leased asset down into low value components. So, I mean, the obviously where people use that term, maybe going to game this. The low value recognition exemption is intended to be more permissive than the equivalent exemption in IFRS 16. The threshold for low value is higher than IFRS 16, which does not state a threshold in the standard itself, but indicates a figure in the basis of conclusions. That's where I think was misled because of working with IFRS too much. This is a key element of making Section 20 changes proportionate for 102. Now, there's a word that tries to be proportionate, but it's used sensibly. This is a good example of proportionate counting thinking. That 102 is practical, in other words. It makes practical sense. So good news there. And I hope that is of good news to any people who are worrying about leased assets. The low value recognition scheme is intended to be more permissive, blah, blah, blah. Here, the basic conclusion also note low value assets can include tablet and personal computers, small items of office furniture and telephones. This is also not an exhaustive list. So I'm skipping through that because it's, in a way, repetition of what it said. Good news, it's not every asset over £1,000, £10,000 or whatever. Identifying a lease should be easy. The contractor is or contains a lease if the contract conveys the right to control the use of an asset for a period of time. Identified lease section 2015 specification of an asset may be specifically specified explicitly in a contract, for example, a building by its address, etc. However, an asset may be specified implicitly at time it is made available for use. For example, the specific item of railway rolling stock which is delivered to the customer on commencement of the contract. So that's that's an interesting item. You've got items sitting there. You could have them in your premises owned by the company that owns them, but it's not available for use. When I say sitting in your premises, it wouldn't, but it's there ready to use, but it's not being used. It's got to be used. And there are substitution rights. So identifying an asset, identifying a lease, in fact, I think sensible practice there, if you like. That's what I'd conclude on that. Right to control the use. The right to for a lease to exist, the customer must, throughout the period of use, have both the right to use the identified asset, the right to obtain substantially all benefits. So the right to use, again, generally, I think seems obvious. For the customer to have the right to direct the use of the identified asset, either the customer must have the right to direct how, for what purpose the asset is used throughout the period, or use in a manner that affects the economic benefits. This is why I'm skipping through this quickly. It's all the words again, but I think the right to use is that you have the right to use it, and you have the right to obtain economic benefits. So if you're using it, I presume you're obtaining economic benefits. But this may be stuff you should study for particular cases. But I would have thought, I hope, pretty obvious. Having said that, potentially complex issues, and this is from Section 20, rolling leases. And again, the answer is it a lease? Is it just 12 months? And we're doing it again. And that's Landlord and Tenant Act. I know nothing about, I'm afraid, but that needs to be consulted if it's tenants and landlords. Measurement of the lease liability. I don't think too difficult because it's discounted cash flow is inherently the implied rate, or the inherent rate in this quasi loan, this loan that you have for leasing the asset. In substance, fixed asset leasing, variable leases, discount rate, interest rate implicit in the lease. I mentioned that, incremental borrowing rates, and so on. Quite a lot of background and guidance because these are issues, some not that complex, and many will not arise for a lot of people. There are also contracts which do not have the legal form of a lease, but which do in substance meet the definition and would therefore be in the scope. For example, a contract could, in a substance, convey the right of control to the use of identified asset, even if the contract doesn't have the legal form of a lease. preparers will wish to satisfy themselves that they have identified all relevant contracts. So, I mean, this could go back to the contracts and revenue. It's maybe good that the accounting standards, these two areas, looking very hard at the legal side of things. We always should. What we're going to do after the break, I think we'll have our break now, is a 10-minute break now to past. That's 9 minutes now. I'm cheating you of a minute. We'll come back and look at IFRS review and then a romp through judgment. And that will be it. So stay around. Review of IFRS amendments, not too many, and a look at judgment. Thank you. Right, welcome back. I'm just looking at questions and oh my goodness. Section 20, it 23, really going to bring issues. And in fact, more on the question of revenue. Most of them were more on revenue, some on leases. I'm going to have to answer these after the event. I'll check that we can get in touch with you because we know who you are. It doesn't come up on the screen or anything else. Because they're interesting, serious questions, and I will aim to get some answers to you. Very interesting questions. And I'm sure there's going to be many more for accountants and everyone out there. Right, but can we, we have to move on. And let's look at IFRS amendments. I think the good news here is that there aren't that many. Some, obviously, some issues will affect people, not others. Amendments to the classification of measurement of financial instruments, the amendments modify disclosure requirements in IFRS 9 and 7. They come in from January 26. So you have time. And as I understand, not earth-shattering amendments. They are to the classification and measurement of instruments disclosures. Not there's no change in accounting. The IFRS also they do have amendments, and that's the only amendments of 26. They're not that many. They do go for annual improvements. They are limited changes that either clarify the wording of an IFRS accounting standard or correct relatively minor unintended consequences, oversights, or conflicts between the requirements of different standards. One on hedge accounting by a first-time adopter. So if you're adopting hedge accounting for the first time, I would guess if you get the latest version of the standard, it should have reference to these amendments. Disclosure of deferred difference between fair value and transaction price in IFRS 7, a disclosure issue. Again, looking at the actual standards should help with that. Gain or loss and derecognition amendments to 7. And again, as I understand, none of these are, to use the word that pops up in accounting and auditing, significant, but they are changes and you do need to follow them. So do use this as a list to check out if you have these items. Derecognition of leased liabilities, amendments to IFRS 9. And that's not leasing assets as much as IFRS 9 is about financial instruments. Transaction price 9, again, financial instruments. 10 is de facto agent determination, and that, going back to revenue, is someone an agent or not? So that's IFRS 10. And the cost method, statement of cash flows, IAS, and it's easy to get confused. There still are lots of IASs around IAS 7. And then this may be for some of you, contracts referring to nature-dependent electricity, wind, in other words, I think, would be the obvious one. Sun and wind, we know both exist, lighting the land. That's not my view on green issues. That's just, we see them. Okay, so that really is there for you as a checklist that if you deal in any of these areas, then you need to look at the latest edition or check what the annual improvements are. What is coming in 2027 is a new FRS 18 replacing IAS 1. And IAS 1, fundamental IAS about the disclosure and financial statements, quite significant in the sense of requirement for mandatory subtotals to be presented, requirements for items of income and expense to be classified into 5 categories, and aggregation and disaggregation of information, including introduction of overall principles of how information should be aggregated and disaggregated. So quite significant, annoying for a lot of us, I could imagine, that we've only got these 5 classes, and annoying because where do we put one of our subheadings? We've always presented it separately. I mean, again, the issues here are silly at times, because if you're a true investor and owner of the company, whatever, you're getting the full P&L account in a style you want, management accounts. You can, never mind the style you want, you can have the full P&L account with subheadings of the headings presented. It does make you wonder about what use financial statements are, and in that case, what use are IFRSs. No, we mustn't go there. And it does amuse me too on this theme, this question of leases and revenues and everything else. Oh, it's to help analysts. Analysts are going way behind the published accounts. I mean, so we spend all this work getting perfect IFRS, perfect accounts presentation and thinking about it, changing it. And meanwhile, serious business people and analysts are digging into the dirt, as it were, or looking and finding a wonderful business as it's meant to be. So changes there are. IS 18, quite a big change for us. And then IFRS 19, IFRS 19 subsidiaries without public accountability disclosures. The only reason I can see for this, and it's not dismissing only, probably very important, it's to specify disclosure requirements for an entity which has subsidiaries, an entity permitted to apply instead of the disclosure requirements of other IFRS accounting. An entity electing to apply this standard applies the requirements of other IFRS accounting standards except for the disclosure requirements. Instead, the entity applies the requirements in this standard. And that doesn't seem to make a lot of sense to me. As I understand it, and that's the wording, I didn't write that, it's to simplify disclosure where you're a non-public accountable, in other words, listed or whatever company, you've got subsidiaries, it's cutting back in disclosure. It's effective for annual reporting periods after January 27 or this earlier application. One thing linked to this this is from an FRC publication, and I was surprised. Personally, I've been slightly puzzled by the fact that the 2006 Companies Act, was it? I'm sure it was, brought in standard formats, layouts, and there was, and yeah, that's the time it was harmonization with Europe. So we had 2 types of balance sheet and a lot of standardization. To me, this has just drifted apart. There's nothing to do with Brexit at all. I mean, large companies do different things and whatever. You've got a heck of a lot of varieties of income statements, P&L accounts, whatever, income statements, balance sheets, statements of financial position. You've got lots of layouts. This is a summation of the issues of what you can do from, again, and I think it's from might be from the code paper. But banking, you've got Schedule 2 statutory format, choice of 2 statutory formats. If you're in these industries, you'll know this. I just thought it's interesting. I'm not wrong. There are a plethora of different layouts, and I'm absolutely right. Appropriate insurance, banking, quite different from manufacturing, and also small entity. There's choices. So that's only an overview. You might like to look at it. I need to dig into it, maybe just to see the clients' accounts, the layouts. Pucker, one assumes the software that does this is all updated for this. I don't think we should assume anything, but layouts going to get standardized of IFRS from 2027 in the UK. There are choices. I think we've got to check we've made the right choice, if you like, doing the right thing. So now to finish, not now, finish, you've got 20 minutes, a quick go through the issue of professional judgment, auditors and directors appointees. This absolutely applies to auditors because there's endless standards that refer to it. It's interesting, the practice note, it's called, for SMEs, has 37 mentions of professional judgment in its 62 pages. So it's very much there. Personal view is I question how much professional judgment we're allowed. It's a very interesting question. This is all about regulation and everything else, but let's not go into that. Let's look at how professional judgment is considered in auditing and accounts. AI says, very good definition, again, professional judgment, definition, ability of a trained professional to make informed decisions, etc. That's rather like it's ISA 200. The strengths, it provides flexibility in complex or unique situations. It recognizes the value of professional expertise. I'm for that. I mean, we do train, we pass exams, and we have experience, and we should be able to make professional judgment. Weaknesses, vague and subjective. Well, it needn't be vague and it needn't be subjective. And that's a good point about the ISA's and the FRC's comments that, we need to evidence our judgments. That's very important. Professionals may reach different conclusions, can be judged harshly in hindsight. And this is where, as a professional, we have real problems, that doing this evidencing and opinion, in a sense, you set yourself up. I mean, you've done it with honesty, integrity, whatever at the time. Times change. How might it be looked in hindsight? A very good point. Regulatory angle. Regulators and professional bodies expect professionals to exercise sound judgment. Yeah, absolutely. That's what a professional does. Failures of judgment can lead to discipline if decisions fall below what a reasonable peer would consider. That's an issue, yeah. This creates a balanced autonomy to decide, but accountability if that decision is later seen as negligent, reckless, or unethical. I think it's a superb summary from good old AI. Right. What does subjective mean? Characteristic of belonging to reality as perceived rather than as independent of mind. So, I mean, that's that. I use Merriam-Webster quite often because the American see what they're saying. They're saying subjective is characteristic of belonging to reality as perceived rather than as an independent mind phenomenal. So what they're saying is it's my dream reality. Interesting. And subjective does have the Cambridge definition that the effects of personal feelings or beliefs rather than facts. And I think that gets it. Subjective is this, it's not fact. It's why we have subjective judgments is because that are decisions and there are two facts and we have to judge. There is not a fact. We wouldn't have anything that's subjective. So the Cambridge definition is quite good. And they actually have that accountant example. That's from the Cambridge Dictionary. Accountants hate, well, not meant to hate anything, hate the subjectivity involved in long-term forecasting. Yeah, we don't like that. We like facts. So I think we know what subjective means. Where is subjectivity required? You all know throughout accounts. With the economist mindset, though, the concept pervades IFRS and IFRS 2. We now have built-in subjectivity. And that's, I'm saying about revenue, though we try and clarify things, maybe it clarifies that there is subjectivity. Highly probable is mentioned. Before we would just ignore that. So we now know something is probable or highly probable. And if it's highly probable, we have to make a professional judgment. So good that the subject's talked about. As many figures are objective, client accounts will have ranges of possible amounts. And the key thing for me with clients and risk assessment is asking about motives. What are your motives? Drivers are good, motives. And when you use the word motives, you see them sort of moving their chairs like, what does it mean? Well, I'm not looking for fraud, but what is your reason for running your business? Demonstrating success, higher revenues, lower costs, higher profits. liability suppression of liabilities. Personal angles to views demonstrates what auditors know, that we need to be skeptical about clients' judgments. We need to be skeptical about our own, for that matter. So subjectivity, quite an issue, and professional judgment important. Where do they appear in the ISAs if you're an auditor? In ISA 200, 15 and 16. Professional skepticism and judgment. I'm also mentioning skepticism here because judgments, I think, inevitably for auditors are meant to be skeptical. The two almost always go together. The professional judgment definition is long-winded, American, but there we are. The application of relevant knowledge, training, knowledge, and experience within the context provided by auditing, accounting, ethical standards in making informed decisions about the course of action that are appropriate in the circumstances of the audit engagement. Rather wordy. I've accused the ISAs of being turgid and tedious, and someone thought that was quite offensive, but I'm afraid they are at times. But anyway, there we are. Professional judgment requirement: the auditor shall exercise professional judgment in planning and performing an audit. Quite right. And that's distinguished features. We are being reviewed. It's just that, I mean, this comes up in FRC cases, at which you'll see, and there's continuing going through. What worries me is that Executive Council in this case do not assert that any of the respondents' breaches result in the financial statements for being materially misstated. This respondents' breaches were limited to discrete areas. The rules were not obeyed, is what I would say. But that's me having a go. Laws and regulations, ISA 250, we need to be skeptical. The laws and regulations section was up for review by the FRC. I think they wanted to really revise it, and the profession had kicked back absolutely rightly. I mean, I've had a question: am I policing you? My clients have said, and the answer has to be, well, yes. And in a sense, this is perfectly right. If you take money laundering, we'd have to report it. HMRC cheating, we would have to deal with it. I mean, so we are. I mean, if there was a material breach of health and safety, or a breach at all of health and safety, we'd certainly have to think about reporting it. So we are policing, but this seemed to be the drift, was to go down the road of really doing a policing exercise on that we could do because we looked at the accounts. But judgment required when applying ISA 250. Deficiencies in control. Other deficiencies are, and what we do, what we communicate, in fact, is a matter of the auditor's professional judgment. Identifying risks, judgmental areas, inherent risk factors. So there's a list for you. These slides come. You can have more slides and some notes on this if any of you are desperate. I'm happy, and I do after these presentations send stuff on. So if you want notes from which some of these slides come, you're most welcome. But identifying risks is a matter for skepticism and professional judgment. I think an important thing I'd say is, what does your client or your customer or your company you're investing, what do they see as risk areas? I don't think we ask often enough. We're meant to ask as auditors about assertions. I don't think some clients know what assertions are, so we have to explain those to them. That's something that ISA doesn't make clear. I mean, other people don't talk about assertions, only they do. And assertion is actually used in an American sense in the ISAs. The British slant, dictionary slant, is slightly different. But in knowing our business, clients' businesses, whatever, what their risks are, and the areas that need judgment, it's a good thing to ask. The risks that require special audit consideration, I think, are obvious. And here we have this word significant risk, and it's interesting. So it's a good way of classifying, but we have material risk, significant risk. We're using too many words, or words in a slightly different way in different areas. But significant risks for an auditor, very sensible, and they are risk of fraud, related to recent economic conditions, complexity, related parties, of course, degree of subjectivity actually in the figure, the risk of significant transactions outside the course of business. I would have thought those are well known to auditors. Um, what should be done and documented? But do the director, shareholders, and other users of financial statements really understand the figures, the rules, concepts? I'm really addressing that to the directors, shareholders. I hope the auditors do, but it's a good question for not just small companies, but people are directors and not in finance, but of other areas. Do they know enough about finance is a question, and what risks in operating something, what risks would pop up in a financial sense? So good questions to ask. They need to ask questions about risks as they perceive them, and they need to be aware of what regulators consider as high risk. And there's another quote from it's a copy of the one earlier that the FRC say this is a high risk area. The FRC do publish these cases. They also say that, look, this is an area we're coming across. Think about it. So we do need to keep up to date with their pronouncements. Our clients, should we judge them? We should we record the judgment? Good question. A related issue is the culture of our clients. Much is made of this, and so by the FRC again. So yeah, we have to judge them. The problem is, again, what you put down in writing and what evidence you have. It's not easy being an auditor. On balance, here's a quiz for you. Are your auditors positive and helpful? And it's a yes or no. And it's totally confidential. So here we go. Good. That's what we like to see. On balance, are your auditors positive and helpful? And I think the profession aims to be, certainly, and that's good. That's really good to see. And but 13% say no. Yeah, well, it's difficult for us. That's the point. Right. That's a good note there. Just not rush to finish. I've got the timing right now. It's always very difficult to get the timing of these things right. Just some more points. Professional judgment. There is a guidance book for the FRC. If you are concerned about this, it goes through the whole process. A lot of words, but useful. There's good points in it. Just some of the points. But there's a professional judgment framework. And I'm not going through this. Be relieved. That's not why I've got enough time. It's just to point out it exists. I never know whether you start in the middle and go out or out and go back in, but it is a useful thing to look at. And you can have, if you want notes on this sort of area, do just let me know. It goes on about significant risk, and of course those are the ones that these accounting and auditing has borrowed from MBAs and things that have these XY charts, and up in this area is the dangerous area, this doesn't matter, sort of thing. But that all is nice and it helps us. I was a German friend. Germans got into auditing standards later than us, just a couple of years back. And I was speaking to one of the managers and saying, you should look at this. This is actually to help you do a risk assessment. And I sent it to him with the line, frankly, I think this is the work of a troubled mind. But I mean, it's meant to help you come to conclusions at the bottom. But yes, I'm sure it is. This comes from not just the FRC, from the auditing standards, International Auditing Standards Board. So there's good material out there to help us. Which now, I think, I want another final quiz, and then a final word or two. So what are your views on AI? Tick all that may apply. So interesting to see what we get here. expecting 100% to all of them. Right, it is wonderful. I wouldn't disagree with that. I said that. It will dumb everyone down. That is quite a strong view as a PwC roundtable on that. And it was interesting. That I think it's a very valid point. It's potentially dangerous. Well, we'll come to that. It is potentially dangerous. Repeat question. Yes, right. You've answered that one. Thank goodness. We will have to live with it. Yes, we certainly will. So we can't ignore it. So not ending on a negative note, a little, well, to me, it was quite a bit of fun and it's not played out yet. Here we have a picture of the Right Reverend Rabbi Ralpho, which was given to me by a Labour MP more than 20 years ago, who had a view that I ranted quite often, whatever. And it turned out it's just a lithograph. And it turned out there were people called ranters in 1750 or something. Then they claimed to be religious, but they were fairly loose livers, I gather, or whatever else. I don't know whether he's implying that about me or whatever. But interesting picture. I never really couldn't find anywhere the true story. So I thought, I'll ask ChatGPT. That's the place to go. And this is where, before I asked, I just Googled by chance the Right Reverend Rabbi Ralpho, and it came up with this picture, a copy of which I have a copy, and there's another copy in the Scottish National Gallery. And they say they know nothing really about it and the background. So I really would like to find out. And if any of you know, let me know. And more, if you know more about the ranters, because it's an interesting topic, and I would tell them. Anyway, I asked ChatGPT. I thought, well, it's all wonderful. What is the story behind a picture of the Right Reverend Rabbi Ralpho? They came back with, I couldn't find a well-documented figure, but however, there was an image, however, the image you provided, likely that of Rabbi Ralph Meckelberger. Okay, if you have context like where you saw the Right Reverend Rabbi Ralpho, I'd be glad to help you. So there it is. That's what ChatGPT said. There was more conversation, but the conclusion is you're absolutely. I had to say, sorry, I had to say I never provided that or any other picture. You're making things up. ChatGPT said you're absolutely right, and thank you for pointing it out. You're correct. You didn't upload or describe any image, and I should not have assumed or invented one. So don't stop using ChatGPT or AI. Great, but you need to have enough intelligence. I've had it making a few mistakes in the times I've used it. I asked it a serious question about lighting LED lights with high voltage. It got that wrong, and its intelligence. I asked it what the significance. If I was talking last year, I may have mentioned the same thing. I said, "What's the significance of 2 to the power 3, 2 to the power 3, 2 to the power 3?" And it actually went into hallucination, as they call it, for 11 seconds. It did nothing. And then it came up with the most ludicrous equations or whatever, hadn't a clue. And of course, the answer is, I wish this was live, I'd get you someone to shout out. The answer is Chinese lucky number, 888. So anyway, I'm just trying to be a smarty with ChatGPT and beat it, but all it does is be sycophantic, almost annoying. AI is good. I'm going to live with it. It's great. And you're great if you're still there for listening to me. And as I say, do get in touch, ask questions on anything. I'll have to take time to deal with your questions I've got. And I think there's some more in actually. And I'm happy to share if there's a slide or an area. If you want material, then just let me know. So thank you very much indeed. And have a good rest of the day and weekend. Thank you.